Hello and welcome to LiveSquawk's financial market podcast on Monday, the 23rd of March 2026. We're bringing you an extra episode this week as the news flow is in overdrive at the moment. Over the next 30 minutes, my guests and I will get to grips with the key stories moving the markets and look at the implications for investors. For this episode, I'm joined by regular contributor Sam Cutler of 333 Capital and a special guest, new guest, Michael Green of Simplify Asset Management. Michael is best known for his thought-provoking research on passive investing's impact on market structure and has presented his findings to the Fed Reserve, IMF, and numerous industry groups. We'll also put his Substack up as well for those who want to read into Michael's work a bit more. Before we get into it, though, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. LiveSquawk is not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Okay, let's crack on. So where to start then? The aim of today's episode, as I said, is to try and offer some insight into how investment managers and traders view the news, the current environment, and how they manage risk and markets with a litany of constant tape bombs that we're seeing at the moment. To give you a small idea of the commentary we've seen over the past 72 hours, just a quick timeline, and we're talking predominantly about the Iran war and the conflict at the moment, but also how that affects the US economy and monetary policy, because it matters for the largest economic engine in the world. So on Friday, we saw comments that from President Trump says we're close to achieving objectives. Trump signaled the US is nearing its war goals and begins floating a potential end to military involvement. Shifting towards a burden sharing, arguing that the Strait of Hormuz should be secured by other nations, not just the US, despite global reliance on the route. There was a winding down narrative, say analysts there emerging from the post that we saw, which is going into the weekend. On Saturday, President Trump gave a 48-hour ultimatum to the IRGC on his Truth Social, demanding Iran reopen the Strait of Hormuz within 48 hours or suffer the consequences. That ends this GMT we're in at the moment, so it ends today, those 48 hours. He also warned the US will destroy, obliterate Iran's power plants, starting with the biggest ones first, and it was escalatory in tone on that front. And then on Sunday, he reinforced that, doubled down on that publicly. But then London morning, this morning, we heard from the president who basically said that they'd extended the deadline, saying that delays his planned strike by 5 days, effectively extending the ultimatum, having said that he had his people had very good and productive talks with Iranian counterparts. There was a claim that major points of agreement had been reached with Iran, and this sent the markets into a bit of a flurry, which we'll come on to. And now it's being read as a clear de-escalation trigger. We saw oil slide, we saw equities soar, and risk sentiment improve. We have, just to caveat, we have heard from Iranian officials that have suggested that there have been no talks and there is no discussion between the two sides about a ceasefire or anything of the like at the moment. But again, it's very disparate between the leadership in Iran, from the army to the actual politicians, and there is articles out there that suggest that Turkey has been involved, Pakistan has been involved in talks, and so there must be some substance to it. So getting back to what does this mean for the US? What does this mean for the markets? This is a financial podcast. We want to keep it to the financial markets and the like, but you can't avoid the political implications, the political impact of everything. So my question here is, what should the reaction function of markets and central banks be? I want to get the economist view from Michael, if you like, and his views, and also from Sam on as a nimble investor, I guess, who's been at the cold front, shall we say, of all this at the moment. So let's start on that question. What should the reaction function of market central banks be based on what we've seen today, predominantly, really from Trump's comments? Michael, I'll give you the lead on this, if you like. What are your initial views on what you heard from the president earlier today, and maybe some of the subsequent comments there from the Iranian officials?
Yeah, I mean, from my perspective, what Trump's apparent retreat is really not a retreat. I think it's highly unlikely that the U.S. Is backing down or rolling over, at least in principle. And I think actually the commentary from the Iranians disputing that there are negotiations with the U.S. largely confirmed that. My interpretation would be relatively straightforward. This is effectively a hostage negotiation where Iran is the hostage taker who is now cornered inside the bank. We have communicated, you're surrounded, there is no way you get out. And their response is, I'm going to kill a hostage. As a hostage negotiator, your immediate next step is, whoa, wait a second. Let's figure this out. In the meantime, you communicate to the SWAT teams, hey, we have active negotiations with the hostage taker. Don't go in yet, right? But in the meantime, what you're really doing is you're positioning snipers. And so I just think, unfortunately, that's the way this has to play out in the public press. It naturally feeds itself into the interpretation of Trump always chickens out, or that the U.S. and Israel have somehow lost due to escalation from Iran. I think, unfortunately, that's largely a political analysis that largely reflects the biases of those making those comments. I'm no fan of Trump. I want to emphasize that. But I do think that there is a high degree of belief that anything that Trump does or says is inherently wrong by virtue of the speaker. And likewise, there's just an extraordinary degree of anti-Semitism that is permeating much of the dialogue, such that the same conclusions effectively boil to Israel. Iran has threatened a very clear war crime. Right, an attack on desalination facilities in countries that don't directly actually have any role in this, primarily because they are the hostages that can actually be executed at this point. That is explicitly a war crime. On the flip side of that, if I search for Iran threatens war crimes, I will find nothing. Instead, what I will find are claims, excuse me, I will find claims that, horror is growing at the threat that Trump made against the electrical grid in Iran. That's not a war crime. That is a very clear delineation under the Geneva Convention that electric grids are dual purpose structures. They are used for recharging drones, among other things, firing missile batteries, etc. They are very clearly targets. They have been attacked in every war in history, regardless of whether you had the Geneva Convention in place or not. And the attack on civilian facilities that would effectively put Saudi Arabia into a condition of true civilian collapse and danger, the world is looking at it and they're like, oh, well, what would you expect Iran to do? This is unfortunately telling you where people are ultimately placing their priorities. They're more interested in trying to score political points than conduct a sober analysis of the facts on the ground.
Okay, just to cut in there briefly, in terms of what the Israelis and the US did initially, and again, it may be in response to what they feared was an impending Iranian threat. But I mean, it's been said by the UK government, it's been said by the European governments that was an illegal aggression, and therefore this is one of the reasons why Europe was so reticent to get involved in the first place. That's the argument. So just so it's for balance of the discussion, that's the argument we made on the other side, that it was what the US and the Israelis have done in itself is an illegal act. In terms of keeping it on the economic or the financial side of things, and we'll come back to your views and what your assessment really of what we're looking at the moment. But from the market perspective, where does today's events leave us in your eyes? Where does it leave us in the sense that does the market now, as an investor, and we'll come to Sam in a minute on this, can you now start to look through this fog and just go, right, okay, well, we are looking nearer the end game than the start here, and this is Trump's words himself that he says he's now giving them a 5-day ultimatum. I've read some of your latest Substack that suggested that the reaction function that we're seeing isn't purely just down to that someone's thrown fired some missiles across the border, therefore oil must go up and risk assets must go down. You again, I use the word nuance. It's a bit more nuanced to that. There are more factors playing into this at the moment. Do you want to explain that a little bit in from your latest Substack in terms of why you believe that is? Why do you think the volatility that we're seeing is related to positioning as much as it is about the geopolitical situation right now?
Well, so I want to emphasize a couple of quick things in that. It is unfortunately somewhat straightforward that if there is an attack on Middle East facilities and a diminution of the ability to transit oil through the Straits of Hormuz and into the markets that need it, that there is a rational response for a demand for oil from those who need it desperately because they have not built up significant reserves. The United States has significant reserves. China has significant reserves. Europe does not, right? And so the simple reality is that being unprepared for this eventuality, Europe is now scrambling for supplies. That's not unique to Europe, but Japan is extraordinarily well supplied. Inventories on a global basis, even if we exclude strategic supplies, we're near record highs. And so I think it's important to understand that the relatively muted, and this is actually a quite muted response in the oil markets, reflects that ready supply in many markets.
Okay.
Just to emphasize the point, like people will draw analogies to the size of this disruption in terms of the quantity of oil that is being disrupted. And if this extends for an extended period of time, it does become quite serious. But they try to draw analogies that, this is 3 times the size of the events of 1973, for example. Mm-hmm. Well, that is true in terms of a fraction of the traded share. And I emphasize that is in terms of seaborne shipments. But the second component is that the price response is a fraction of what we saw in the 1970s. In the 1970s, oil went from $5 to $30. Now we've seen oil go from $60 to $100. In other words, less than 100% increase versus a roughly 600% increase.
Sure.
The world is significantly more elastic in its response to oil than it was in 1973. In 1973, roughly 30% of U.S. production capacity was tied to diesel generation. Today, almost no production capacity in the United States, at least, is tied to oil. A sizable fraction is tied to natural gas, but natural gas is extraordinarily well supplied in the United States. And in fact, we're a significant net exporter of it at a fraction of the BTU price of oil. There's far greater elasticity on the demand side. We're already starting to see countries like Australia, et cetera, debate whether they want to reintroduce COVID restrictions on movements in order to reduce their reliance on imports. Mm-hmm. That's telling you, the extreme measures that can be taken early on. A lot of people remember things like, even odd license plates, et cetera. That was really a feature of the second oil crisis in the 1970s, in which the U.S., recognized that it had this dependency and this relative inelasticity, and they forced it through the demand channel. That becomes a much more serious component. This is nothing of that scale yet. Could it become that? It's certainly possible, but the forwards in oil contracts largely suggest that that's not the case. And as a result, there's a lot of other factors that we need to be much more thoughtful about in particular, why did we see the moves that we saw in interest rates, equities, credit spreads, etc.?
Yeah.
That's where I would argue what we saw much more of was what's referred to as a VAR shock, or a value at risk shock, tied to an unexpected significant increase in the risk weighting of assets that are held on portfolios. That basically forced a deleveraging on Friday, and Friday's behavior was perfectly consistent with that. Today's behavior, with a strong rebound in particular SOFR futures, is something I specifically spoke about in my Substack, and is, again, unfortunately, perfectly consistent with the interpretation of Friday's activities.
Okay. There's a lot to unpack in that, and we'll come back to it. But I want to bring Sam in as well on this as well. Where do you see yourself in terms of into us with? And do you agree with that? Is there anything you want to add in terms of what you've seen in the marketplace over the last few days?
Yeah, I mean, I think Mike covered the overview on everything exceptionally well here. I'll go into a little bit more like the nitty gritty kind of intraday moves that we've seen on, some of these back and forth headlines between Trump and some folks in Iran. I mean, this morning you saw an extremely violent, market reaction to this, where you saw Brent dropping, 14%, WTI trading around 86 a barrel. I mean, the S&P opened up about 2% higher. You saw Europe, kind of reverse all their early losses. Treasury yields were pulling back some here. And, you saw that Fed tightening that was starting to get priced into the market. I think there was about 11 or 12 bips priced in there. You saw that kind of come off as these headlines came out. But, we kind of saw that rally start to fade after Iran came out and kind of denied that. And then the IDF confirmed it was continuing strikes on Tehran. So I think that pretty much sums up that this is a headline driven market right now. And, Trump's deadlines, as we know, tend to be, very elastic. So I think this is kind of the binary headline risks that makes this current vol regime pretty dangerous, right? If this leads to a genuine de-escalation and the strait opens, I think you saw prime, what will happen. You're going to see spots rip, volatility is going to melt, people's hedges are going to get roast, and Delta is going to get, bought back up. If it turns out to be noise and the conflict continues, which, Tehran's denial suggests that, it's possible, we'll right back to where we were, and possibly even a little worse. And I say worse because, anyone who would kind of cut their hedges on some of these, positive risk headlines is kind of now naked into the escalation. And I think, as far as central banks and where everyone stands, I mean, I think, this oil spike, it's a supply shock, right? It's not a broad-based demand-driven inflation episode like we saw in 2022. And my opinion here is, that at least, so like to put it into the US context, I'm of the opinion we have unemployment trending higher, core inflation has been moving lower, consumer spending to me is softening, and policy rates are, already kind of elevated relative to neutral. So I think this is really the complete opposite backdrop of 2022, when we had really hot labor and we had, 8% headline CPI. And, Michael made a point there of noting, how well oil has been behaved here. And if you just kind of look historically at oil spreads, right, on the curve, like if you take the 1 year minus the 1 month spread, kind of the divergence, it's sitting right around, I think 26% right now. And historically, when these divergences hit plus 15%, minus 15%, has tended to be kind of a solid signal in tops and bottoms for oil prices here. I think then moving on to central banks, right? Like I was really, I was offside on this. I came into this, I was, receiving UK and receiving European stirs on this. And I got a little smoked on this, but I thought central banks, were going to kind of recognize the difference between a supply shock, oil spike, and kind of that demandful inflation, and hiking into an already slowing economy would really be a policy error like Trichet in 2011, right? They hiked into a slowdown and had to reverse within months. And I say this, as I look at I'll look at inflation markets for that. Like we saw those 1 year inflation swaps just absolutely skyrocket. Now there's a bunch of reasons to not like 1 year inflation swaps, but if you look at some of the I don't want to say longer dated, but some of the different tenors. Like if you look at a 5-year in the US, right, it's sitting right around 2.34%. The 1-year swaps right around 2.43%. So these aren't levels screaming for, emergency actions. And I think moving forward, central banks are going to be watching these closely. But you look at kind of what happened in the market, like Michael said, the outrageous kind of pricing unwinding here in, I'm going to call it the stir blow up that came from the UK. And I mean, it's not like it's unusual for the UK to cause some liquidations. And
no, but can I just before you get into that, on the fiscal environment for the UK and the political environment for UK probably lends to it being a far more volatile asset class in terms of there's very little faith in the current administration in that sense, and I mean it's we're talking paper thin sort of confidence in the finance minister, the chancellor of the exchequer. So maybe that's just we shouldn't exaggerate moves on that front, simply because as a UK assets really aren't deemed that secure at the moment.
Mm-hmm. No, 100%. I think like Michael mentioned this too, like kind of the positioning coming into this, and how he mentioned kind of the VAR shock of forced liquidations. Like if you think about kind of, being a PM here and kind of the stuff we saw, right, there's been a lot of people that I'm sure have been positioned kind of short volatility across these stir options, right? And that could be, selling a strangle on your IBORs or Sonia, right? And you can harvest some decent carry off those trades by selling these tails that you think are very unlikely, right? Like you're happy to sell the tail that the BOE won't hike this year, for instance, right? But those tails kind of all exploded simultaneously. So you get this kind of cascade, right? So first you have to start like hedging your short gamma, which forces you to pay rates as rates sell off. Then you're kind of forced to close your full short put position, which then subsequently kind of bids vol and you sell more delta. So it's like that classic non-linear liquidation spiral, and the flow itself is driving the move, not as much as the fundamentals, right? So I think exactly the forced liquidation dynamic that we saw is exactly kind of why the front end here is overshooting. And like Michael said, you're seeing, some headlines here and some repricing of this today. So I think, the rate repricing, I'll say, has gone kind of well beyond what the inflation data justifies. And I think the evidence is starting to show, like just the other day, I think this was on Thursday, for the first time since the start of this crisis, we saw a 10 bips retracement in that 1 year euro inflation swap. And, 1 year break even is pretty stable at 2.1%. But you got, the Euribor December 26 contract still selling off another 10 basis points. So I think that divergence there is the fingerprint of, kind of forced positioning flow and not that fundamental repricing.
Okay. Brilliant. This brings me back on to Michael. So we're looking at this from a monetary policy perspective. Like you say, the bond market itself was not primarily about oil or geopolitics, but an elastic unwind in rate markets and whatever. Do you think the central banks have got it wrong then? Or are they trying to bridge two sides here? We're trying to, with their public, not persona, but they're trying to explain stuff to the public in a simple way, but also making sure that everyone else, investors and everyone else, knows exactly what the score is. Have they done a poor job in communication over the past sort of couple of weeks, especially last week, because you had a lot of central bank activity out last week? Have they underplayed the situation and made it very linear when they should be a bit more nuanced and a bit more sort of careful in their language, Michael?
Candidly, I mean, look, I think part of the problem is that we all feel entitled to know what our leaders are doing and have them justify their behavior at every step in the process.
Yeah.
What that largely reflects is a public that feels disempowered and is desperately seeking validation that others are also disempowered. The simple reality is that central banks led by the U.S. Federal Reserve have done a terrible job of navigating this crisis. First, spending their time debating, inequities and DEI type frameworks in 2021 instead of hiking interest rates in response to a surge in demand that was occurring at the same time that there was a very clear shortage of supply. and then in a panic, hiking interest rates to such an extraordinary level that it functionally killed the economy. We don't see that data, in part because of the various shenanigans that we've engaged in to try to more accurately represent a new economy. I'll just give a really simple example of that. Unemployment claims remain low in the United States. That needs to be considered in the context of we have not adjusted unemployment benefits for nearly 20 years in the United States now.
Okay.
That means that the value of an unemployment claim has fallen by give or take 65% in real terms. It's far more interesting to consider that the new form of unemployment is driving for Uber or DoorDash. If you match up Google searches for drive for Uber versus versus new business formation, which is another skewed statistic that is being reported that supposedly indicates a renewed entrepreneurship within the United States. That unfortunately was due to a change in policy in the treatment of what's called 1099 forms and tax reporting. In 2021, we changed that threshold from $20,000 to $600, necessitating many small businesses and gig workers to actually obtain business licenses in order to expense the depreciation of their vehicles that they were driving, etc. Those two track almost perfectly until the One Big Beautiful Bill, to use its acronym, certainly not how I think about it, restored those thresholds. And from that point, we actually see this huge divergence between drive for Uber and business formation that tells you that the data that we looked at was simply wrong. The economy was not hot in 23. It was not hot in 24. It was not hot in 25. And we maintained interest rates at extraordinary levels. And that is having the predictable consequence of positioning us for an incipient consumer and business credit crisis, where bankruptcies have surged to unprecedented levels, particularly for small businesses. Consumer bankruptcies are rising at a rate that exceeds that of the prelude to the global financial crisis, once we were already in the global financial crisis. And meanwhile, as you're pointing out, or as Sam, I think, correctly articulated, and I don't think it was 2011, I think it was 2008 that he was referring to, where Trichet hiked interest rates to fight inflation as the world faced a deflationary credit crisis. So I think they're doing a terrible job, but that's my opinion, and I'm not a central banker.
Okay, so this is a very simplistic question. So you're in the Myron camp, where you think they should have cut rates sooner, earlier. Some say he's a shill, and he was there because Trump's put him there. But in principle, what he wanted to do, what he was trying to get them to do, was to try and insure against what potentially could be an oncoming recession, or at least dip in economic activity down the line. So you're not totally against what Myron had to say about that.
I just think Myron's doing it for the wrong reasons. I do think he's a political shill, but he's
the underlying message is the right.
Yeah. I mean, you can be right for the wrong reasons.
Yeah. Okay. So going back to last week's FOMC, and again, and all central banks, they've stated they want to wait and see how this plays out. Maybe not. It's probably the sensible thing to do. Come and wait and see if we are looking at a short war, or if we're looking at something that impacts infrastructure a lot more. Reading what I've read and seeing what I've seen, it's going to take a while before a lot of these plants come back online in the Middle East and the Gulf, before we start getting back to the level of oil supply and delivery that we're used to seeing from the region, no matter what happens in the next week or 2 weeks or whatever. What does this do to productivity? I'm talking about, I want to stick to the US on this. Again, do you think we're heading for a US recession, Michael? Do you think that as you said, looking at the labor data and everything that we've seen from that we're already 1 foot into that basket? And should the Fed be a bit more proactive? And was it that hawkish in the first place? And should it really rail back on that and try and send a better message to the public and the markets?
Well, I think the answer is pretty straightforward. The Fed is much less concerned with the actual expectations channel, which, as Sam and you both pointed out, has been remarkably contained. What's reflected in inflation swaps is actually a market expectation. They're much more concerned with expectations of cocktail parties in Washington, D.C. Than they are.
A bit cynical.
It's a little bit cynical, yeah. That candidly, they are embarrassed by their mishandling of the economy. They want to prove that they are indeed, as Powell, rhapsodized philosophically at a recent speech, that they are capable of living up to the standards of Paul Volcker, who they perceive as the world's greatest central banker. I don't share that view. But as a result, they're more concerned with their reputations than they are with the developments in the U.S. economy. I think, candidly, the U.S. economy is far less interesting than, the implications for European and Asian economies, in particular, those that basically stood by the side and said, well, it's not our problem to deal with the Straits of Hormuz. You broke it, you buy it. That just is indicative of how badly placed your leadership is, right? This is your problem, not ours. In fact, we are the solution to this problem. We'll just sell you very richly priced oil and gas.
Okay, well, listen, I don't totally disagree, but I mean, at the point that the Europeans didn't want to do anything about Iran as an entity other than to do it via talks and to do it on the political side of things, I guess they missed the move. Then they missed the.
Shocking for such a talented crew, isn't it?
Well, as a European, I guess, yeah, trust me, we can go through a whole litany of things they've done too slowly. Right, Sam, same thing to you then. If we're heading for recession, you're looking as a PM. How do you play this? Looking at the markets now, taking for everything that Michael said and you said about this current market fluctuation that we've seen was forced liquidation and positioning, and the underlying picture is one where we're but we're still looking at maybe cuts further down the line then, and all this talk about we'll have to wait and see where we are at, and all this pricing, and we priced out very quickly. I mean, we were looking at 4 rate hikes for the UK, for example. That's now down to 2 rate hikes at the back end of this year. I mean, it's a very fluid situation. How do you handle that? How do you face that as a PM?
Yeah, well, I mean, I got to emphasize, I was offside coming into this. So, I really expected, and I don't want to say I expected central banks to stay a little more neutral in their language. I knew there would be some caution because of, the moves we'd seen in oil, what kind of in the shorter end inflation swaps had done and kind of how that feeds into consumers and their thoughts on things. I figured they'd be a little neutral, but not as toned to say, okay, look, we're essentially ready to hike, right? Because again, I still view this is a growth headwind, and it's not, a rate hike catalyst. And like Michael said before, I think it's really a question of when, not if, the market kind of comes around to pricing that view. And on the recession front, I mean, we've spoken for months about this, and I view the U.S. economy much weaker than what the data, if you take the data at face value, suggests, right? I think the labor market is weakening. It has been weakening. I think an interesting point was on March 6th, we got that data dump, right? And I mean, you had, I think NFP missed by like a negative 6.1 standard deviation. The U rate was like a negative 1.8 standard deviation miss. Manufacturing payrolls was like a 2.6 negative standard deviation miss. So it's not just one noisy number, it's a cluster. And less in that NFP, we did have, some strikes and weather disruptions in there. And yes, the break-even rate is probably lower, but, I think mechanically it's much more weaker under the surface. And we already were seeing consumer spending softening before this oil shock, right? So now if they're facing the additional headwinds of higher energy and, food prices, it's still just squeezing their disposable incomes. So on the recession front, I mean, I think it's really hard to call it just because of the way this market has been behaving. I think you need a much weaker equity market to induce, actual job layoffs, as we've seen, continuing claims stay relatively neutral. But I think that's kind of something to go on here. It's like, yes, this has been, I'll do quote unquote quietest war of a lifetime for the US, right? From an equity spot perspective, S&P is what? It was down like maybe 5% off its highs. So it's been in kind of a choppy down range, but it's really kind of refused to break down, even as the geopolitical backdrop like is screaming risks, and you're seeing these, kind of forced liquidations in stir rates, right? So I think a lot of this comes down to kind of the mechanics of the market, because we still have pretty low single stock correlation, but we still have pretty high dispersion, which kind of crushes that index level realized vol. So if you look at like S&P 1 month correlations, I think we're up in like the mid 75th percentile, while realize is still sitting in just like the 19th percentile. So I don't want to say the equity market is supported because of investors or people's, stronger economic view. I think it's more a mechanical support that's going on right now.
Yeah, I'm not sure if you cut out there. I would just echo that. I mean, again, the work that I'm known for on passive suggests that that's exactly what we're seeing, right? People continue to be continue to be employed. The flows have certainly weakened. We've seen discretionary trading activity, but by and large, that underlying bid continues to exist.
I didn't press my button, but I was going to say that there is the Fed put, really, that the Fed is there when it sees markets, and it's one of those like sort of cynical views that the Fed will always look at the equity markets, and when it starts seeing it erode too fast and too hard, that it comes in and offers some support in one way, shape or other, with jawboning or otherwise. I've got a note here from Morgan Stanley that says, we see the Fed path as asymmetrically tilted towards cuts. And they see the shift to a two-sided policy rate guidance may need a different chair with a different lean. We're going to round it up now. But Michael, do you think with the incoming wash, we'll get a far more even-handed Fed and one, despite him being nominated by President Trump, although, Powell was back in the day, that he'll come there with a bit more even-handed. He'll look at the situation, obviously, and be minded by what his boss has asked him, his boss's remit. But in today's environment, the way expectations are, or even short-term inflation expectations at the moment, it's going to be a hard argument to make that they should be cutting sooner or in the near future. As and when he comes in, if he comes in when he should, and I think that's in debate whether it's going to be in June or maybe in a bit later now. Do you think he has to play an even hand at the moment and just really just get his feet under the table before he starts making any sort of dovish or calls or otherwise?
I tend to think that Trump is a poor reader of personalities and incentives. Every piece of evidence we have of Warsh is that he is actually a quote unquote sound money advocate, as you would expect, given his personal position as the nepotistic heir to a fortune. The simple reality is that once he's elected, or more accurately appointed and confirmed, I think there will absolutely be a temptation to echo the broad view that inflation is, the scourge of our times, and that he should remain firm. The history of new Fed chairs is quite poor to that reality. And my sense is that all the algorithms that have been trained on Powell's language will struggle to be updated for the change in tone for Warsh. And I think, if anything, market reactions will likely force his hand sooner rather than later. Okay,
fairly put. Sam, anything to add to that?
No, I'm pretty much in agreement with that.
Excellent. Listen, we've gone over time, but I'd literally like to thank both Sam and Michael for their input today. We could go on for another hour on this. We really could. We could get into all the little bits and pieces, even Warsh's family background, but we can say that for another time. Michael Green, thank you very much for taking part today. I really appreciate you coming on and speaking with us. I'll put your links up there. This is Michael Green, Chief Strategist and Portfolio Manager for Simplify Asset Management. Thank you for today.
My pleasure.
And Sam Cutler of 333 Capital. Thank you as always for taking part and breaking down some of the detail for us.
Yeah, always a pleasure, Harry.
Thank you. And as I said, I think we could go on again for another hour or so about this because there's so many different facets to all this, but we have to wrap it up now. But Michael, I'd love to have you on again as a guest, and Sam, obviously we'll see you again in the near future as well. But yeah, that's the end of this episode. If you missed the start of it, go back on the social media or onto the podcast platforms and listen from the start. We'll post all the links up to our guests and to the episode on all our usual places. But thank you again, guys, and have a safe and prosperous week.